Hi, this is Peter from Game of Trades, and this is going to be an extremely important episode. We're going to be discussing some warning signals that we're seeing on the charts, on some indicators that suggest that we may see a short-term pullback on the S&P 500 within the next couple of weeks. So that's something that we're going to be discussing today. We're going to be going through those warning signals one by one, and then we're going to discuss how we're adapting our strategy on our S&P 500 trade following those warning signals. Now, we've been trying to keep a bullish bias on the S&P 500 for quite a while. Ever since we broke out above here, we switched aggressively from a bearish bias where we were looking for a resumption of that downtrend right here and a reversal at resistance, and we switched to a bullish bias, buying the dip and booking profits after big blow off top moves, again buying the dip right here at support. And something happened recently that we've been talking about almost every video since then. We've broken through this line of resistance. So we are keeping that bullish bias intermediate term on the S&P 500 because we need to trade the chart that's in front of us, right? Do not try and be smarter than the market. What is the market telling you right now? It's telling you that we're making higher highs and higher lows. So we're clearly still in an uptrend. We haven't had a technical breakdown. So the warning signals that we're about to cover, yes, they are relevant, but it doesn't mean you should be selling all your positions on the S&P 500. And it definitely doesn't mean you should be shorting right now, right? You need to see a technical breakdown before selling or shorting. And that's exactly why we're looking at the charts day to day, working through these tiny moves, not trading them, but seeing what's happening on the charts. We entered once in October and once on this breakout right here. We're not trying to trade these small moves in between, but we're watching the price action to see if there's going to be a technical breakdown, and seeing the indicators that I'm about to show you today should raise some concerns for anyone who's long on the S&P 500 right now. If you're interested in these types of trades where we enter on high probability moves, right? High probability breakouts, like the trade we had back here on this strong breakout above this consolidation pattern, and you want to work with us through these kinds of trades, booking profits at targets, raising the stop loss, adding additional targets. That's what we do on gameoftrades.net. So make sure to go check out our website if you're interested. And of course, subscribe to the channel because that is our trading style on this YouTube channel. We really focus on those high probability moves. We don't want to get caught up in that day-to-day price action. So now, without further ado, let's get right into those warning signals. Starting with the gamma exposure on the S&P 500. So right here, you have a chart, the black line right here of the S&P 500, and below the blue line corresponds to that gamma exposure. Now, we don't often use this indicator to predict price movements, but when we get extreme readings like the one we just got a couple days ago, it does raise our concerns a little bit. So what is the gamma exposure exactly? It's basically a measure of how quickly the option contracts that currently exist, how fast they vary in price depending on the price moves in the S&P 500, right? Because when you're buying options, they're not perfectly proportional to the S&P 500, right? It highly depends on what's happening, how overextended is the trend, or how oversold the dip is. And so the measurement for that, the measurement that gives you how sensitive those option contracts are, is the gamma exposure. And in the current environment that we're in with high speculation, and pretty much everyone is buying calls on the S&P 500 trying to capture these gains, while paying attention to this is perhaps a good idea right now. So we got that extreme reading right here. So let's take a look at how this type of extreme reading can affect the S&P 500. How quickly does it affect? And so you can see right here, we're going to focus on that 2018 high right there. So you can see we had that extreme gamma exposure reading right there on January 8th, 2018. And we had the top of the stock market on January 29th. So you had that extreme reading on January 9th, and a few days later, you did have a small pullback on the stock market. So this is the type of move you'll get from a high gamma exposure reading. Same thing right here. You had a high reading on the gamma exposure, and a few days later, you had a nice move down. Now, like any indicator, it's not 100%. Don't go out after watching this video shorting the market just because we got that reading. You can do that if you see a technical breakdown on the chart. That would be a higher probability trade. I'll show you another example right here. High gamma exposure, and that corresponded exactly to the peak of that rally right there. So again, that's the first warning signal we're seeing. Now let's move on and get to the second warning signal that we're seeing on the stock market. By the way, make sure to like this video if you're so far enjoying this content. It really helps out the channel, boosts our videos to a wider audience, so we really appreciate that. And by the way, if you have any comments, make sure to leave them down below. We do read all the comments. We try and reply to as many as possible, but we're really loving all the support that you guys have been showing us over the past few weeks. Thank you so much. Now let's get to the second warning signal. And for that, we're going to take a look at the RSP, right? This is something we've taken a look at before on this channel. This is the S&P 500 equal weight ETF, right? So it's the same basket of stocks that's in the S&P 500, but instead of them being unevenly weighted, so having just a few stocks make up half the ETF and then the rest being divided into small proportions, instead of that, you have an equal weighted basket where every stock has the same impact on the S&P 500 as any other stock. So if the RSP is doing really well, it means the entire stock market, the whole basket of stocks, is performing well. So seeing the RSP outperform the S&P 500 is actually a good thing for the stock market in the short to intermediate term. And we can actually take a look at that in more detail, right? We can take a look at the RSP divided by the SPX, and then we can actually see the relative performance. How is the RSP performing relative to the S&P 500? And so that gives us this chart right here. And this is something we've taken a look at before. We were in this zone right here under this resistance level for quite a while with a brief rally right there in June. And you can see following the vaccine news, I believe November 9th it was, we had a breakout backtest and then rally. And so the RSP has been doing extremely well over the past few weeks on this rally. So right now you're probably wondering, how is this a warning signal? And I'm sure some of you have noticed by now that we're heading into resistance. So this is not a good sign for the market breadth. This means that investors are likely going to be starting to book some profits on the RSP as it reaches this resistance level. You can see how significant it is, right? It held as support right there in February. And this is when the breadth really started degrading once this support was broken. And right here on that rally in June, this is exactly the point where the RSP reversed. So we are paying attention to this ratio, and seeing this reverse could suggest that we're going to see degrading breadth over the next few days. And if we see that type of a move with the S&P 500 continuing higher, that would suggest that the S&P 500 is due for a pullback, right? And I'm going to show you what I mean right there. We're going to go on a 4-hour chart so that we can see more clearly. And I'm going to superimpose the S&P 500 here. And you can see on this downtrend right here, that was the degrading breadth that suggested the S&P 500 would likely top. So you can see you had good market breadth all the way through. Then it hits that resistance level right there, and you start seeing the RSP underperform all the way to a significant top. So that's something we could see right now, and we'll definitely keep you guys updated based on what we're seeing right here. Now let's move on to the third warning signal that we're seeing right now for a potential pullback in the stock market, and that is interest rates. So we're taking a look at the 10-year bond yield right here. This is probably the most important chart in terms of bond yields that you can look at. And so you can see bond yields have been rising right here. What does that mean? It means demand for borrowing is increasing. And so that pushes bond yields higher. So generally seeing interest rates means the economy is doing well. People are borrowing more money, but it does have a few consequences. And that's why we do consider this as a potential warning signal for the stock market. If interest rates rise, what does it mean? It means it's more expensive to borrow money. And so basically what's happening with rising interest rates is borrowing is a lot more difficult. And so something we've covered many times on the stock market is that the entire environment that we're currently in is because the rates are low, right? And when you have low rates, you can increase borrowing and you can increase growth expectations. And that's what the market is all about right now. You're seeing a huge number of companies with no profit, but huge amount of growth expectations. So that's why everyone's flooding into the stock market, is because all these companies are borrowing massive amounts of money and feeding those growth expectations. But all of a sudden, if you've got rising rates, it means borrowing's more expensive, and that puts pressure on the stock market. So if rates continue rallying, you're going to see that put some pressure on the stock market. Higher interest rates lower the valuations of the stock market, and that is something that is undebatable. So we're going to see how far this goes. It's not necessarily a short-term warning signal, but if we continue seeing rates go up all the way to at least 1.4, that would tremendously increase the cost of borrowing in an economy that's still extremely fragile. And so that could be the catalyst to turn the tide from a recovering economy borrowing itself out of a crisis to an economy with lower growth expectations, again, turning the tide on the stock market. So definitely pay attention to that. In the short term, we do believe that rates are going to be coming back down to this trend line right here. From a technical standpoint, that is the highest probability moves in the next few days, and that could provide some fuel to gold that seems to currently be forming a bottom. By the way, if you're interested in all that type of analysis, making connections between stocks, interest rates, bonds, precious metals, global markets, cryptos, we cover all of that in premium episodes. We try and follow the money, follow the trends, and make high quality investments based on value and not growth expectations, because we do believe that higher stock market prices is entirely dependent on rates staying low, and that is just not a bet that we're willing to take on with our capital. So now, how do these warning signals impact the way we're going to be trading the S&P 500 right now? And as I said at the beginning, we still have a bullish outlook on the stock market as long as we remain within this price channel. So we're not going to be selling our positions. We're still holding from our trade right here all the way to our fourth target. But something we are going to be doing, and I'm going to go on an 8-hour chart to show you that, we're going to be raising our stop loss on that trade. The original stop loss we had was around right here as we entered on that back test. Then we raised our stop loss to around 3,600 points right here, just below this candlestick tail. And now that we're getting some warning signals, we're going to be raising that stop loss to book additional profits all the way to around 3,700 points. And why are we choosing that stop loss? I'm going to show you right now. We can duplicate those trend lines and put them on lower reactions right here, capture these reactions along the way, this reaction. And so you'll see this is the last line of support that we have on the S&P 500. If that gets broken, we don't want to be participating in the S&P 500 anymore. We'll get stopped out here, and then we'll be closely looking at how the S&P 500 reacts right here. This is going to be a potential zone to re-enter a big swing trade on the S&P 500 if we see proof that this is going to be holding as support. Now, again, this all assumes that we are going to be seeing a pullback, which, as I say again and again, anything can happen in the markets. Never put your convictions too high. Make sure to check out our website at gameoftrades.net if you're interested in finding out about our investment strategies outside the stock market that are focused on the weak dollar plays, precious metals, emerging markets, commodities, and how we're entering and exiting our positions on those assets. Now, that's about all I wanted to cover in this video. If you enjoyed, make sure to drop a like on this video and subscribe to the channel if you haven't already. Now, as always, good luck on your trading, and see you next time.